All right, let's talk about the dangers of REIT investing. Now, frankly, there aren't that many, but if you don't know what you're doing, you don't look out for these 5 things we're going to talk about, you could actually get into a bad investment with public real estate. Now, if you just randomly pick one, odds are you're going to do pretty well relative to just randomly picking a stock because we're talking about hard assets, and for the most part, these are lowly leveraged. There's not a lot of debt on these assets. So it's hard to mess up real estate without a lot of debt. It's a physical property, it's a lot of them, they're paying rent. Not too many things can go wrong. All right, let's start with number one. Number one is sucker yield. And that just means a very attractive double digit, sometimes even a high single digit yield that's compelling. It's attractive. A lot of retail investors see an 8%, 10% dividend yield and they get very excited because, hey, who doesn't want 10% a year in passive income in an investment that's also supposed to appreciate? That's a dream investment. However, oftentimes that high dividend is a warning sign. You need to see what percentage of cash flow is being used to support that high dividend. If their dividend is 10% and 99% of their cash flow is being used to pay that dividend, that's a payout ratio of 99% of their income to the dividend payment. That's not good. That's probably not sustainable. A lot of things have to go right for that to keep going. They can't have any surprises. They can't have a big capital item on one of their properties. They can't have a weather event. Everything's got to go really smoothly to keep that dividend payment. Dividend cuts are no bueno for REITs because a lot of retail investors buy these for their cash flow, for the dividend. When they see a dividend cut, even if it's temporary, that generally is going to be a pretty big discount in the stock in the short term. So sucker yields, to avoid those, once again, you're going to be looking at the payout ratio. You're automatically going to have your spidey sense up if you see a double-digit dividend on a REIT, unless we're in a huge bear market. Sometimes in a huge bear market, you can get those crazy dividend yields, but absent of that, a 10% dividend yield is more likely to be a sign of distress and something weird going on with that company and management team of the properties than it is an opportunity for you to invest in. All right, number two. This is a big one. There are some REITs that issue way too many shares in order to grow. Now, REITs have to issue shares to buy new assets. The reason for that is because they have to distribute 90% of their income in dividends each year to maintain their tax treatment. REITs have an amazing tax treatment. They are not taxed at the corporate level like every other company, which is a big advantage. But as a caveat to that, they can't hoard the cash and just keep growing their cash without having to pay any taxes. They distribute it to you. What does that mean? That means that if in order to grow, REITs don't have a giant piggy bank of cash flow, a war chest that they can always use that's never ending to acquire new assets to grow. They generally have to, at some point, issue more equity, issue more shares in the public market, and then use that cash to go buy new assets at a profitable margin. So they are issuing equity cheaper than they are buying the real estate. And that is what compounds these returns over time, which is wonderful. However, there are some REITs that they're not very good at capital allocation. They issue equity all year long, all the time, regardless of what their stock price is. Their stock price might be 50% of the value of their real estate, just because the stock market moves up and down, and yet they are out in the market issuing new shares in order to go buy real estate and basically lose money. So you ask, why would they do that? Some, not many, but some REITs are incentivized to grow because they get property management fees, and they're not really capital allocators. They're thinking about their own team instead of the investors. And once again, this is very rare, but there are externally managed REIT teams that are just hired guns. They're not shareholders, they're not stakeholders in the company. They don't own a ton of shares. They just want that fee revenue from property management. And so they're oddly incentivized to just grow the assets, to just keep empire building, because they're taking property management fees for each of those new assets. And they don't care if the stock price is muddling along and not doing that well. They just want to grow. So as Charlie Munger has always said, you got to look at the incentives to get the behavior that you want. So always look at the incentives. And in the case of those REITs, they're going to be issuing shares regardless of what the price is, and they're going to dilute your equity if you're a shareholder. The value of your shares are going to slightly go down over time because there's more and more shares out there available to the public market, and there's not enough properties and cash flow to make up for that growth. You want the opposite of that in REITs. You want the shares to be barely increasing over time relative to the cash flow, which is going to the moon, of course. That's the dream. The best REIT management teams are are capital allocators. They are investors through and through, not just real estate investors, but capital markets investors, stock investors. When they see that their stock price is, say, 80, but they think the value of their real estate in the private market is 100, they don't want to be issuing shares down here. That's diluting their own shares, their own equity if they have shares in the company, which most do. What they do in this case is they will sell a few of their private assets, take that spread, and then perhaps they'll buy back some of their stock, which actually increases the share price because there's fewer shares available. And now they're back to 100 and all is right with the world. Okay, then what happens when their stock price is overvalued in their mind? Maybe their stock price is now 120. The stock market's just ripped. It's getting a little detached from reality, like 2021. Stock price is up here. This is when you want to issue shares, right? Because you can issue shares at a higher value than what you can buy real estate at. So you issue shares at 120, then you take that cash and you go buy more real estate at 100. It's magic. That's the kind of REIT management team that you want. Those are the kind of REITs you want to pursue. You don't want to look at REITs that are just issuing shares willy-nilly because they want to grow. They want to empire build. So that was number 2. All right, number 3. You want to avoid REITs that are carrying too much debt. So it's an obvious one, but unless you're screening for it, you can buy a REIT that's actually pretty risky because they're carrying just way too much leverage relative to the value of the assets. And so this is just like thinking about buying a home. You probably wouldn't want to put a 99% mortgage on your home, your personal home, or 95, 90. The banks aren't going to let you do that anyway because they think it's dangerous, right? And the same kind of goes for real estate. In commercial real estate, you tend not to see leverage higher than 75% on the vast majority of deals. And weirdly, in the public market, the leverage is actually much lower, which is great. The leverage tends to be 50% or below for the highest quality REITs. So there's a ton of equity that sits above that debt. There's a lot of room for error. There's a lot of room for things to happen, the economy to go through recessions, random mispricing, rent declines, capital surprises. There's just a big cushion relative to most private real estate, which is a much smaller cushion, which juices the numbers here. So it's actually not really a fair comparison because REITs, when they have 50% equity cushion above the debt, they're actually, on a risk-return basis, pretty attractive, and they're getting similar, if not better, returns than the private real estate that's actually really highly leveraged. But that's another video. That's another conversation. But you still want to avoid the REITs that are pushing those levels. And you'll see this in 2 ways: the debt to enterprise, which is basically the same thing as a loan to value, an LTV, or you'll see it in their debt to EBITDA, which is basically debt to income ratio, which is just saying how much debt do they have compared to 1 year's worth of profit. And the industry standard right now for the large REITs is in that 6 times debt to EBITDA range. The second you start seeing double digits, you start to get a little nervous about how much debt that firm has. Can they support those debt payments, still support their dividend, and also take care of surprise capital items, right? Capital expenses that might show up at the property. This is just another item to be looking out for. If the debt is extremely high, you're talking 20 debt to EBITDA ranges, that's a scary situation. Or if they have 75% leverage and we're going into a possible recession, those teams are going to be playing defense. Very few of them will actually go bankrupt. You almost never see a REIT go bankrupt because, once again, they have assets. And usually the debt is just isolated to individual deals. It's not across their entire portfolio. So they could actually give one property back to the bank if something should go terribly wrong. But you still don't want to be investing in a REIT that is on defense during a downturn, that is so focused on what they currently have and making sure that they don't lose that, and is putting out fires. You want a REIT that's actually going offense in a recession, that's out there buying distressed deals from private operators. That's a great time for these firms to grow. You want to be a part of that. You don't want to be trying to figure out, okay, what property we're going to lose this month. Make sure you're not investing in over-leveraged REITs, and once again, there's very few of them, but something to think about. All right, moving on to number 4. What is number 4? Oh yeah, don't invest in REITs that are subsidizing their tenants. Now, I know this is an obvious one, but you'd be surprised. Every once in a great while, you will see a REIT that actually is cutting checks to some of their larger tenants. And this may be perfectly fine if there's some extreme situation like COVID, where the REIT has decided that they are going to make an investment into one of their tenants' businesses. It's frowned upon, but can be understood if it's an isolated incident. The problem is when you start seeing this ongoing and this becomes a habit for the REIT, because that starts to look a lot like a Ponzi scheme. And I can't go into any specifics, but you just have to be mindful if you see or hear any situations where the actual REIT management team is cutting regular checks and investing in the tenants of its properties. This isn't black or white. I've actually seen one of the largest mall companies buy out some of their tenants and take over those businesses. Completely rare, but it's actually worked very well. So this isn't a 100% never just sell out of any REIT that does that. It's just a red flag, because if that is ongoing and that becomes a habit, that's the whole basis for the company. You're writing checks to the tenant, they're writing checks back to you, and then you're sending a dividend payment to your investors. This starts to look a little bit like a Ponzi scheme. Once again, this is extremely rare. It's a big outlier, but just something to look out for, because it's not a great situation if it keeps going. Moving on to the last and final, number 5, and this might sound a little obvious, but avoid REITs in a declining sector. For example, in 2010, it was pretty obvious that the internet and e-commerce was going to impact retail, was going to impact malls. And you could see the slow burn in these mall REITs over the next decade. Now they've actually thinned out, and there's one major one that's actually pretty good. But there were plenty that just slow death. This wasn't something that happened quickly. This wasn't a decision you needed to make in a quarter, or you lost all your money in a quarter in some mall REIT. This was a very slow burn. This was like just a crash waiting to happen. So any point along that way, you could have exited or just avoided altogether. And something similar is going on with office right now. It isn't promising for downtown commodity-like office buildings that are going to have to reinvest a ton of money to attract new tenants and already have declining occupancy. Work from home appears to be a real trend. And so once again, this didn't happen overnight. They didn't crash to zero in 1 month. They are slowly burning right now. If you can just avoid sectors that are having structural problems, your returns are going to be above average relative to most people who are investing in REITs. And this is one of the best things about investing in REITs. Things aren't moving at lightning speed. You can see what's happening and see what's going to play out over the next few quarters, if not a couple of years, in advance. And so if you're diligent about real estate, if you're watching the private markets, if you're getting the broker reports and you're seeing the leasing stats, if you're looking at these things and not just throwing a dart at the dartboard and saying, I want this REIT because it's got a high dividend, if you're looking at these things, you can feel really comfortable about your investment, even if it's doing this, because those properties are just going to keep kicking out cash flow. You're going to earn great and growing dividends for a very long time. Hopefully that was helpful. Thanks a lot.